In today's video, I'm going to be talking about and reviewing the best trading apps in Australia. When it comes to buying and selling shares in Australia, there are so many different brokerage platforms that you can use. Personally, I use Commsec, but my biggest hate is how much they charge in brokerage fees. If you're investing tens or even hundreds of thousands of dollars, then you can end up paying a lot just in brokerage fees. And these fees can also really burn into your long-term profits. Like if you look at this chart that shows the value of $100,000 invested over 20 years, you can see how fees really start to impact on your bottom line returns. Like if you look at this chart which shows $100,000 invested over 20 years, someone who is only paying a 0.25% annual fee is going to end up with $210,000 after 20 years. Whereas someone who pays a 1% annual fee is going to end up with $180,000 after 20 years. That's a difference of $30,000 just by paying an extra 0.75% in average annual fees. There's always going to be costs associated with investing, but if you can try and reduce your brokerage fees as much as possible, as well as investing in the lowest cost investment products, then the difference can really be staggering after some time. I've paid over $280 this year just by investing in Commsec, and it's likely going to cost even more when I eventually do go to sell those shares and they go up in value. So in today's video, I'm going to be reviewing the top brokerage platforms in Australia. Biggest factor here is going to be fees. I'm going to go on a rant here and say how much I hate brokerage fees. The big four banks just charge so much money for us hardworking Australians to buy and sell shares just because their businesses are well known and trusted. But that doesn't mean you shouldn't consider other alternatives. The biggest challenge a lot of Aussies face is having to either pay a lot of money to go with a secure brokerage, or alternatively use a smaller and lesser known brokerage platform that might not be as secure. Well, that's why I've done my research, and in today's video, I'm going to show you guys the best trading apps to use. So the first option that you can use when buying shares in Australia is by going with a big four bank brokerage platform. Personally, I think if you're new to investing, then investing through a big four brokerage platform isn't actually a bad idea. Then as you get more and more experience selling shares, maybe consider doing some more research into some of the other stock platforms that are out there. For the most part, the price to sell shares using these platforms is about $20 per trade, up to the value of $10,000. And then it's usually 0.1% of the trade value for any trades over $25,000. Then they jack up the price if you want to buy international shares. And you still can't buy international shares once you've opened up a brokerage account with the big four. You have to go through a separate process of completing more paperwork and apply for one of their international trading accounts. And with Commsec, you're charged $30 per trade for trades up to the value of $10,000. And then 0.31% of the trade value for any trades over $10,000 US. And it costs even more if you want to buy shares in other markets like in the Asia Pacific or European stock markets. They also then hit you with an additional 0.6% foreign exchange fee. Then if you haven't bought or sold any shares within a year, you then have to pay a $25 inactive account fee. If you think that's bad for Commsec, have a look at ANZ, which charges $59 per international trade up to the value of $10,000, plus the additional 0.6% currency conversion fee. It's also pretty similar for Westpac and NAB, with NAB being the only brokerage which charges $15 per trade up to the value of $5,000. It's important to note though that the reason why these brokerage platforms are so expensive is because they have what's called CHESS sponsorship accounts. To put simply, CHESS sponsored means that the ASX, or the Australian Stock Exchange, has a record of you owning those shares. This means that when you go to buy shares through either ANZ, NAB, Westpac, or CBA, your shares are CHESS sponsored, meaning that when you buy or sell shares, the ASX has a record of you owning those shares directly. You don't have to opt into it, but this is something that you need to seriously consider when choosing to decide a brokerage platform. When you join a broker that offers CHESS sponsored shares, you'll get given an ID, and the shares are attached to you via that number. This is called a HIN, or a holder identification number. It typically starts with an X. You can have multiple HINs across many different brokerage accounts and platforms. So you can technically have one HIN for Commsec and another HIN for Westpac if you're buying and selling shares across the both brokerage platforms. This also allows you to move your shares and the ID that's attached to them across from one brokerage to the other. The most important thing to remember is that if your shares are CHESS sponsored, you own those shares directly as opposed to someone else owning those shares on your behalf. You also receive dividends and have voting rights as well. You're probably thinking at this point, why on earth would someone else own your shares when you have paid for them? Well, the reason is because there's a ton of other brokers out there, including IG Markets, Interactive Brokers, and Superhero, which actually operate under a custodian model. A custodian model means that they actually buy and sell shares for you on your behalf when you place a trade on one of their brokerage platforms. I'm going to explain in more detail how custodian brokers brokerage accounts work and how this is different to CHESS-sponsored accounts. CHESS stands for Clearinghouse Electronic Sub-Register System that's used by the ASX to record who owns what in the stock market. The HIN is your unique identifier that holds all of your trade records against it. But the broker is buying and selling the shares on your behalf on the ASX. It's kind of like having a mobile number and a cell service giving you mobile phone reception, but only you can access that reception through your own unique mobile number. So every time you buy shares through a CHESS-sponsored brokerage account, it's recorded against your own HIN until you decide to sell those shares. It's the brokerage platform that charges you money for buying and selling shares on your behalf and then registering those shares against your HIN. And this is why it costs so much money to buy and sell shares through CHESS-sponsored accounts. In order to save on fees, there are a ton of other brokerage platforms out there, including Superhero, Interactive Brokers, IG Markets, and Stake, which for the most part just use one HIN number for all of their trades. These are known as custodian brokers, and this HIN number is their own. If you go with any one of these brokerage platforms, you're unlikely to receive your own HIN number. And what this means is that the brokerage platform only needs to pay ASX commission for placing trades with that one HIN number, as opposed to paying fees for each individual trade for each of their individual customers with their own unique HIN numbers. The savings made on this are then passed back to customers in the form of lower brokerage fees. But a major problem with using a custodian broker is the risk of them potentially going bankrupt and therefore shutting down their own system, which has a record of who owns what shares. And this is because a custodian broker has to keep their own records of who owns what shares throughout their brokerage platform. And it can get very difficult to work out who owns what. And the ASX isn't going to know who owns which shares on that brokerage platform either. Because according to the ASX, the broker is the sole owner of those shares through their own HIN number. It can be very difficult to therefore prove that you're the rightful owner of those particular shares if a custodian brokerage goes bankrupt, because you're ultimately at the mercy of them keeping the correct records of you owning those particular shares. There is no protection provided to you by the ASX of you owning any specific shares using a custodian brokerage account. This can get very messy, especially if they don't keep proper records of who owns what shares. And this actually recently happened with a custodian broker called BBY, which went bankrupt in 2016. Interestingly, BBY had both CHESS-sponsored and custodian customers. When BBY went bust, the HIN investors had a record of their shares recorded by the ASX, and so were therefore able to easily move their shares across to another brokerage platform. But clients on the custodian model still haven't received the distribution of their shares almost 6 years later. Fortunately, KPMG, who are the liquidators of BBY, have now been able to finally provide a deadline of when those shareholders can receive their distribution payments. And that's in September 2021. But it's only going to be around 3/4 of their original equity that they owned. And this shortfall is due to BBY keeping poor financial records, and in some cases, transferring client funds to external third parties, which is very concerning. Now, the second problem of using one of these cheaper custodian brokerage accounts is the lack of an ability to transfer shares across from one brokerage platform to the other. There can also be a lack of communication with customers regarding their shares and record keeping of their investments. For example, if you wanted to transfer your shares across from a custodian brokerage account to a CHESS-sponsored account, it will be really difficult to do so because the two systems don't really align with one another, because they're technically on different sub-registers. And the custodian brokers could all have their own unique way of keeping a record of who owns what. Whereas if you wanted to transfer shares between CHESS-sponsored brokerage accounts, like if you wanted to transfer shares between CBA and NAB, for example, it would actually be relatively easy and simple to do because they both use the same standardized way of record keeping. So if custodian brokers don't keep valid records and keep up with their due diligence, then you may miss out on dividend reinvestment plans, voting as a shareholder, or share purchase plans. And ASIC thinks the same as well because they actually fined Westpac's custodian brokerage division for failing to notify around 300,000 customers of corporate actions taken by publicly listed companies. For example, if a company made an announcement on the ASX, such as when they go to release their full financial year results, Westpac failed as a broker to update their customers. And that's likely due to poor record keeping copy of who owned what shares. Now, this is Westpac, a well-known and trusted Australian brand, and a huge opportunity cost for its customers as well. Now, I'm not a licensed financial advisor, so the decision to go with either a CHESS or a Custodian brokerage is simply up to you. However, personally, I prefer to pay a few extra dollars for a trade, knowing that I've got the security of a CHESS-sponsored account. And that's because the ASX has a record of who owns my shares. This means that if CBA went bust, which is highly unlikely anyway, I could easily just transfer my shares to another brokerage account. Now, that being said, there are other CHESS-sponsored brokerage accounts which have much lower fees than the big four. These include ThinkMarkets, SelfWealth, and CMC Markets, which I'll now review in further detail. The first is ThinkMarkets, which has been around since 2010, but have only recently launched their share product trading services in 2020. They charge a flat brokerage fee of $8 per trade up to the value of $200,000, and then a 0.05% fee for any trades that are beyond $200,000. So it's effectively only $8 per trade because it's highly unlikely that anyone's going to be placing a single trade worth more than $200,000. And even if you did have more than $200,000 to invest, you could simply just split these out into separate trades that are worth below $200,000. Because if you placed a trade that was worth over $200,000, you would effectively be paying $100 in brokerage fees. So it would technically just be cheaper to do two trades that were each worth $100,000 and pay only $16 in brokerage fees. You can't buy US stocks on ThinkMarkets, but it does provide you with the CHESS sponsored HIN, which makes the app pretty secure. There's also no account keeping fees, so you're basically just paying brokerage fees. But this is pretty standard across most brokerage accounts. Overall, the app is pretty good, but it's certainly not as good as Commsec. So if you really care about brokerage fees, whilst at the same time having that CHESS sponsored security, then ThinkMarkets delivers on both of these things. The next product is SelfWealth, which has a brokerage fee of $9.50 per trade and allows you to trade with a minimum investment of $500 per trade. Now, you can buy US shares through SelfWealth, but the problem is that they do charge a lot of money for buying US stocks like the big four brokerage accounts. So they charge a 0.6% currency conversion fee, which kind of defeats the purpose of using them if you want to buy US stocks. Also to point out as well, if you buy US stocks through SelfWealth, you aren't given a CHESS sponsored HIN because that system isn't actually set up in the US. So if you did invest hundreds of thousands of dollars through SelfWealth and the platform does go under, it's going to be very hard for you to get that money back. Now, the brokerage platform doesn't charge any inactive fees, but you can pay $20 a month for a premium account, which gets you access to a whole bunch of chart analysis and research. I certainly don't think it's worth paying any brokerage platform any sort of money for research or chart analysis. It's a waste of money in my opinion, especially if you're new to investing. And this applies to all brokerage accounts. The app also allows you to make trades with market or order limit types. Basically, it allows you to buy shares at the current market price, or alternatively state to the market how much you are willing to buy those shares for. And the trade will eventually get executed if someone is willing to sell you their shares for that given price. So for example, if the current price of CBA is $102 a share, you can either buy at market value, which is whatever the lowest current sell order is at the time, or you can elect to buy CBA at whatever price you choose, such as $100 a share. And when you want that offer to expire as well. If the share price of CBA doesn't fall to $100 within that expiry date that you set, then your order simply doesn't go through. Overall, the app itself is actually pretty good. It's got a live chart of when you go to buy and sell stocks, but it's not overly great either. Next up, we've got CMC Markets, which is actually really well known and has been around for a really long time. CMC Markets provides you with CHESS sponsored holdings, and in some respects is the fifth giant of the big four banks when it comes to share trading. But the best thing about CMC Markets is that their trading platform is actually a lot cheaper than the big four banks. And this is because you only have to pay about $10 per trade. CMC Markets also rewards you if you trade more, because for your first 10 trades, you have to pay $11. And then for the next 20 trades, you only have to pay about $9.90. And then anything beyond that is still only $9.90 or 0.075% of the trade value. Just be aware though that there is a $15 a month inactivity fee if you don't place a trade within 12 months. CMC Markets gives you access to great live trading data, chart analysis, and investing tools. But to be honest, none of this really matters if you're new to investing. If you really wanted to save money on brokerage fees, then you could technically just spread your funds out across multiple different brokerage accounts accounts that offer some good introductory bonuses to new investors. The final app that you can use that's got chess sponsorship is called Perla. Perla is another new brokerage platform that offers super low rates, and you only have to pay $9.50 per trade, and also $0 for some ETFs. There's currently 45 ETFs where you don't have to pay any brokerage fee at all. The best thing about Perla is that there's no minimal investment. It is important to note though that you do want to be cost efficient with your trades if you do buy shares through Perla. There's no point only placing trades worth several hundreds of dollars and still have to pay that $9.50 brokerage fee, because you're then technically paying a brokerage fee that could be up to 10%. You'd want to be paying at least $1,000 per trade for these brokerage fees to be cost effective and justify the use of Perla. Now, you can't buy US shares, but you can place both market and limit orders as well. But the huge problem with Perla is that it doesn't give you access to live market data when you go to place a trade. You only see a market price, which actually makes it very difficult whether you want to buy in at that particular price. Another thing to consider is that Perla doesn't have an app at all, which I personally don't like at all, because I always check my shares throughout the day when the stock market is open. So to be honest, Perla is mildly cheaper, but in my opinion, you're probably better off using CMC Markets if you had to choose between CMC and Perla, simply because CMC is only marginally more expensive, but at the same time is a much larger company and the user experience is a lot better. But overall, in my opinion, I would only want to be choosing brokerage platforms that offer chess sponsorship, even if you have to pay a bit more. I'm now going to talk about some of the brokerage accounts in Australia that don't offer chess sponsorship. The first one is called Superhero, and this is one of the newest trading platforms in Australia, and it's only been around since September 2020, and it offers a $5 per trade flat rate, but also for any ASX ETFs, you don't have to pay any brokerage at all. This is really incredible, because if you want to just buy an ETF that simply tracks the ASX 200, like BlackRock's IOZ, then you don't have to pay any brokerage fees at all. You're not going to find fees this low anywhere else. This really is, at the moment, the cheapest brokerage platform in Australia. You only need $100 per trade, and you can also buy US shares with only a 0.05% currency conversion fee. The platform also allows you to make market and limit orders, and there's no inactive fee. And the app itself is pretty good to use as well, because it's very similar to the US trading app Robinhood, allowing you to make trades and view your account balance really easily. But again, there's a big risk if you want to buy shares through Superhero. And the reason why their brokerage fees are so low is because they don't offer chess sponsorship, meaning that if Superhero as a company were to go bankrupt one day, then you will likely find it very difficult for you to be able to recover your shares. And that's because they only use a single HIN, and so therefore hold the shares on your behalf. So the shares aren't legally yours in the eyes of the ASX. IG Group is another broker which doesn't offer chess sponsorship, but is able to offer really low rates at only $8 per trade, as they don't need to pay the ASX for each individual HIN number trade. Another thing to consider is that you actually then only have to pay $5 per trade, or 0.05% if you have made 3 or more trades in the previous month. It does charge though $55 per quarter for inactivity if you haven't made a trade within the last 12 months. Now, that being said, IG Group has been around for almost 40 years, and it's also listed on the London Stock Exchange as a publicly traded company and made over £650 million in revenue in 2020, so it's highly unlikely to go under. Their platform also has pretty good chart analysis, live market data, and the ability to trade from their IG app as well. So their overall user experience is actually pretty good. And in my opinion, it's certainly more credible than Superhero, which has only been around for about a year. Another group to consider is Interactive Brokers, which have been around for even longer than IG Group. But again, this brokerage doesn't provide you with the chess sponsored security. Their platform is actually really difficult to use because it involves a lot of complex tools and chart analysis as well. It's certainly not worth using as a beginner, in my opinion. But again, you only have to pay $5 per trade, or 0.08% of the trade value, which goes down if you then spend over $3 million on trading within a month. But to be honest, any beginner investor is not going to be paying over $3 million per month in trades anyway. There's also an inactivity fee of $10 per month. And finally, there's Saxo Markets, which actually gives you the option of buying shares either under a chess sponsorship or through their custodian model. Meaning again that the shares aren't registered in your name. The difference here in brokerage fees is staggering, where you have to pay $15 per trade for a CHESS HIN or $7 for the custodian trade. They also have a web-based trading platform for retail investors and a more advanced trading platform for day traders. It's important to remember though that regardless of brokerage fees, there are other ways that these platforms can make money and essentially rip you off in some respects. The way that they do this is by increasing the spread price between what you actually bid for a particular share and the price that it actually gets executed at. What that means is when you go to buy a share at its current market price, you're not actually buying the shares at that current market price. You're actually paying a bit higher than the current market price in order for the brokerage account to successfully execute the trade of your shares. What that means is that there's a spread between what the actual market price is and what you go to buy those shares for. And the difference between the market price and what you buy those shares for is called the spread. Some brokerage accounts will take advantage of that by actually increasing the spread on those particular trades that you make. And what that means is that you're essentially then paying a higher fee for those shares as opposed to if you were to go with another brokerage account where the spread might actually be less. And so therefore, as a result, you're technically paying less for those shares. That's actually something though to consider in a separate video altogether. So out of all of these platforms, which is the best to use? Well, personally, I just simply wouldn't invest any of my money using a brokerage platform which doesn't offer a CHESS sponsored HIN number. And that's just simply because of the risk of them going under and me not being able to recover my money. But at the same time, you don't want to be losing out on potentially hundreds of thousands of dollars over 20 or 30 years by having to pay so much money through the big four brokerage platforms. Therefore, ThinkMarkets is really the best option in terms of the cheapest brokerage platform, but also at the same time giving you that security of a CHESS sponsorship. But otherwise, it might be better to stick with the big four as you begin with your investing journey. I know that Superhero is technically cheaper than ThinkMarkets because it only offers $5 per trade, but the difference between Superhero and ThinkMarkets is really only $3 per trade. And remember that Superhero doesn't offer you that CHESS security. Whether spending an extra $3 per trade for that peace of mind and security is purely up to you. But so long as you're making a start investing at least some amount, then that's what's most important. Thank you so much for watching. I'm going to continue uploading more and more content this year. So please be sure to like this video and be sure to subscribe for regular updates. Thanks for watching.